Cadence Design Systems, the software stack behind every major chip design on Earth. No Cadence tools, no Blackwell GPU, no iPhone processor. NASDAQ CDNS.
$92 billion market cap. Fiscal year 2025 revenue, $5.3 billion, up 14% year over year, 86% gross margins. This is a software toll booth on the semiconductor industry.
Electronic design automation is how chips go from concept to silicon. You cannot tape out a 5-nanometer chip without EDA software. Cadence and Synopsys own that market.
Cadence was founded in 1988 from the merger of 3 EDA startups in Silicon Valley: SDA Systems, ECAD, and Solomon Design. The goal: build the tools chip engineers live inside.
The 1990s consolidated EDA into a two-player market. Once a chip team picks a platform, they do not switch. The switching cost is measured in years of engineer retraining.
2004, ICOS Systems brought enterprise emulation. 2012, Tensilica added processor IP. 2021, Anirudh Devgan becomes CEO and launches intelligent system design chip through board in one continuous flow.
2023 and 2024, Cadence.ai and the Cerebrus Autonomous Layout Optimizer ship. AI that redesigns chip floor plans on its own. 10 to 20% power and area improvement per run.
Revenue, $5.3 billion in fiscal 2025 across 5 segments. Functional verification leads at 29%, Xcelium simulation, Palladium emulation, Protium prototyping. Every chip gets verified before it gets built.
Digital IC design and sign-off is 28%. Innovus place and route, Tempest static timing. This is where chip engineers spend the majority of their day.
Custom IC at 17%, transistor-level schematics in Virtuoso, IP at 15%, memory controllers, PCIe, and LPDDR interface blocks that customers license rather than build from scratch.
System design and analysis rounds out the last 11%. PCB layout, electromagnetic simulation, thermal modeling. Cadence moving up the stack from chip to package to complete system.
The unit economics look like a software company should. Non-GAAP gross margin, 86%. Non-GAAP operating margin, 39%. Recurring revenue, 85% of total. Multi-year contracts, no churn.
R&D is 30% of revenue, over $1.6 billion annually. That is how the moat gets maintained. Tools stay one generation ahead of any would-be disruptor.
Non-GAAP earnings per share compounded at roughly 17% annually over the past 5 years, from $2.71 in 2020 to over $6 in 2025. Every AI chip wave adds another design run.
Free cash flow margin above 30%. Over $800 million in share repurchases in fiscal 2025. Cadence initiated a $1.20 annual dividend in 2024. Growth story first, capital returns second.
Competitive picture. Only Synopsys can match Cadence across the full EDA stack. After their Ansys acquisition, SNPS broadened into multiphysics simulation and system analysis.
Cadence counters with Clarity 3D and Celsius thermal solvers, plus tighter AI integration across the design flow. The two-player duopoly holds. EDA has no room for a third full-stack competitor.
Platform reach. NVIDIA designs Blackwell on Cadence. Apple designs the A-series on Cadence. AMD, Qualcomm, Intel, all Cadence shops. The platform is not optional for anyone taping out at advanced nodes.
Cadence.ai is the long-term bet. Cerebrus Optimizer, Jet AI for advanced packaging, AI-driven sign-off. The goal is cutting 12-month chip design cycles to 6 months through autonomous optimization.
The EDA market is a toll booth on every dollar of chip revenue. AI does not threaten that toll booth. AI makes every chip more complex, which means more design runs and more Cadence revenue.
Anirudh Devgan has been CEO since June 2021. Carnegie Mellon PhD in electrical engineering. IBM research background in computational design. Joined Cadence in 2012 to run the digital and sign-off group.
He built the AI native design strategy from inside R&D before running the company. Devgan's thesis, chip complexity has grown beyond manual optimization. Cadence automates the gap and captures the economic value.
The concentration risk is real. NVIDIA and a handful of hyperscaler AI chip programs are a meaningful share of the business. A slowdown in AI capex hits design starts.
But 85% recurring revenue absorbs cycles. Multi-year subscription contracts keep printing even in down semiconductor quarters, and the installed base of 5,000 customers provides a durable floor.
4,000 plus IP blocks in the catalog, decades of design data embedded in the tool flows. Competitors cannot replicate that institutional knowledge in a decade. It took Cadence 37 years to build it.
Cadence enters Q1 FY 2026 from a position of strength: 14% full-year revenue growth, accelerating AI tool adoption, and every major chip program running on their platform.
That's the company, the operating model, and the leadership. Now let's get into the numbers from this quarter.
Starting with the headline print. Welcome to Charged Alpha. I am Lana, and with me is Hudson. Today we are breaking down Cadence Design Systems, ticker CDNS, and their first quarter 2026 earnings report. Cadence put up a clean double beat: revenue above estimates, earnings above estimates, and a record backlog of $8 billion. And yet, the stock barely moved. That tension is the story.
The context matters here. Cadence had already rallied 22% heading into this print. When a stock at 35 times forward earnings beats by 5% on the bottom line, the market asks, is that enough? For Cadence in Q1 2026, the answer was a measured yes. A 2.8% gain on modest volume, not a celebration, a verdict. Cadence Design Systems is one of the most critical and least discussed companies in the technology stack. The company traces its roots to 1988, when two EDA firms, SDA Systems and ECAD, merged to form the essential software platform for electronic chip design. Today, every major semiconductor company in the world, NVIDIA, Apple, AMD, Intel, runs Cadence tools in the critical path between chip architecture and silicon tape-out.
Cadence's product portfolio covers the complete chip design workflow. Digital design tools create the logical blueprint. Custom and analog tools handle precision mixed signal circuits. Functional verification confirms chip behavior before a single wafer is manufactured. In 2026, Cadence added an AI layer across every product line, the Cadence.ai portfolio, and launched two new platforms, ChipStack and AgentStack.
Electronic design automation is a small industry by revenue, roughly 15 to 20 billion annually, but enormous in leverage. It sits in the critical path of a semiconductor market worth over $600 billion per year. Cadence and Synopsys together control roughly 70 to 80% of the EDA market. No chip goes to production without passing through one of their platforms.
ChipStack is an AI-powered orchestration suite that automates multi-chip system decisions, previously requiring months of manual engineering. AgentStack embeds task-specific AI agents directly into verification, physical design, and timing closure workflows. These are not incremental upgrades. They represent Cadence's bet that AI will compress chip design timelines from years to months, and that Cadence will own the workflow when it does.
Anirudh Devgan has been president and CEO since December 2021. He joined Cadence in 2012 after building his career at IBM Research, holds a PhD from Carnegie Mellon in electrical and computer engineering, and under his leadership grew the company's backlog from under $4 billion to a record $8 billion. The intelligent system design strategy, embedding AI into every product, is his initiative.
The headline numbers for Q1 2026. Analysts expected $1.451 billion in revenue and $1.17 in GAAP earnings per share. Cadence delivered $1.474 billion in revenue, a 1.6% beat, and GAAP earnings per share of $1.23, a 5.1% beat. Both lines above consensus, a clean double beat.
The revenue beat of 1.6% represents 18.7% year-over-year growth. A year ago, Cadence reported $1.242 billion. The business added over $230 million in annualized revenue in 12 months. For a software company with 85% gross margins, that incremental revenue flows to the income statement with significant leverage.
On the earnings line, GAAP EPS of $1.23 beat the $1.17 estimate by 5.1%. Non-GAAP adjusted EPS was $1.96, stripping out stock-based compensation and acquisition amortization, approximately 4% above the non-GAAP consensus. The underlying business is performing above expectations on every adjusted metric, Cadence reports.
So why only a 2.8% post-earnings reaction? 3 reasons. First, the stock had already rallied 22% in the 60 days before earnings. A significant portion of a good print was already in the price. Second, free cash flow margins compressed from 35.6% a year ago to 20.8%. The market wanted margin expansion. It got revenue growth instead.
The third factor cuts in Cadence's favor: the record backlog. $8 billion in total backlog at the end of Q1, with $4 billion expected to convert into revenue in the next 12 months. That is approximately $330 million per month in contracted locked revenue. Forward visibility of that quality is rare for any software company at any market capitalization.
Let us put the quarterly revenue trend in sequence. Q1 2025, $1.242 billion. Q2, $1.275. Q3, $1.339. Q4, $1.440. Q1 2026, $1.474 billion. Sequential growth in every quarter, an unbroken acceleration across 4 consecutive periods, capped by an 18.7% year-over-year jump.
What is driving that acceleration? The AI chip design boom. Every hyperscaler, Amazon, Google, Microsoft, Meta, is designing custom silicon at an unprecedented pace. Every advanced semiconductor company is pushing to smaller nodes and more complex architectures. Each increase in chip complexity requires more compute hours on Cadence tools, more verification runs, more IP licensing. AI's appetite for custom chips is Cadence's structural tailwind.
The $8 billion backlog deserves precise analysis. This is roughly 1.5 times Cadence's full-year revenue, a record. The backlog is composed primarily of multi-year licensing agreements with foundries, fabless chip companies, and hyperscalers. These are not spot contracts. They are commitments signed 18 to 36 months in advance, where customers pre-commit to a specific toolset for a designated design program.
The $4 billion converting in the next 12 months directly supports the FY 2026 guidance raise. Cadence lifted its full-year revenue midpoint to $6.175 billion, up from the prior $6 to $6.1 billion range. When management raises guidance and simultaneously shows you the contracted revenue that backs it, that is a qualitatively different kind of guidance than an aspirational projection.
ChipStack and AgentStack are bets on the next EDA cycle. ChipStack's AI super agent automates complex multi-chip system decisions. AgentStack embeds task-specific agents into verification, physical design, and timing closure workflows. If Cadence demonstrates its AI tools shorten chip design timelines by even 20%, the value proposition for a premium license fee becomes self-evident to every customer.
The partnership announcements from Q1 add strategic weight. Cadence expanded its collaboration with NVIDIA, the most important chip design customer in the world right now. It deepened foundry certification at TSMC's N2 and A16 nodes, and it announced an Intel Foundry Accelerator agreement and a Google Gemini integration. These are not press release relationships. They are multi-year workflow commitments at the leading edge.
Let us walk the income waterfall. Revenue for Q1 2026, $1.474 billion. Cost of revenue, $214 million. Gross profit, $1.260 billion. An 85.6% gross margin. That is among the highest gross margins in the software sector. For every dollar of incremental revenue, Cadence keeps 86 cents after direct costs.
Below the gross line, operating expenses reflect a deliberate investment posture. Research and development consumed approximately $490 million, roughly 33% of revenue, and growing 15.7% year over year. That R&D growth is faster than revenue growth of 18.7%. Cadence is investing ahead of the revenue curve. Management's bet, ChipStack and AgentStack need capital now to generate licensing premium later.
Adding SG&A of approximately $339 million, GAAP operating income, EBIT, lands at $431 million. That is a 29.3% operating margin. On a non-GAAP basis, adjusting for stock compensation and intangible amortization, operating margins run closer to 45%, comparable to the best pure-play software names.
Below the operating line, net interest income and other items add roughly $35 million. After an approximately 28% effective tax rate, net income for the quarter was approximately $336 million. Divide by 273 million diluted shares, and you get GAAP earnings per share of $1.23, 5.1% ahead of the 117 consensus.
The gap between GAAP and non-GAAP EPS at Cadence is structural and substantial. Stock-based compensation runs at $300 to $400 million annually, a real expense, but one that does not consume cash in the quarter recognized. When you add it back alongside acquired intangible amortization, non-GAAP adjusted EPS for Q1 2026 was $1.96, approximately 4% above the non-GAAP consensus.
Management's forward EPS projection for FY 2026 is $7.90 at the non-GAAP midpoint, a range of $7.85 to $7.95. For FY 2027, Street consensus sits near $9.15 adjusted, implying roughly 15% year-over-year growth. Revenue guidance was raised to a $6.175 billion midpoint, reflecting conviction in the backlog conversion schedule.
The balance sheet is clean. Cash and equivalents stand at approximately $2.75 billion, with an additional $120 million in short-term investments. Total long-term debt is $2.48 billion, carrying at fixed rates from Cadence's 2022 note issuance. Net debt is roughly $270 million. For a company generating $1.7 billion in annual operating cash flow, that is essentially debt neutral.
$2.75 billion in cash is a strategic asset. It gives Cadence optionality. Pursue acquisitions in adjacent EDA or IP spaces without equity dilution, accelerate buybacks if the stock corrects meaningfully, and fund ChipStack and AgentStack commercial deployment at full scale. Cadence has not been historically acquisitive in the Synopsys mold, but the AI cycle may change that calculus in the next 12 to 18 months.
The $2.48 billion in long-term debt reflects the 2022 senior note issuance that funded Cadence's intelligent system design platform expansion. Notes carry fixed rates in the 3 to 4% range, favorable by current market standards. Net debt to EBITDA runs at approximately 0.14 times. The interest coverage ratio of 12.8 times means debt service is not a constraint on any capital decision Cadence makes.
0.14 times net debt to EBIT. For context, the average S&P 500 technology company runs closer to 1 to 2 times. Cadence has the financial architecture of a company that has been printing cash for a decade and reinvesting it intelligently. The risk in owning this stock is not the balance sheet. It is the multiple the market assigns to the earnings.
Total equity stands at approximately $5.4 billion, with a return on equity of 21.9%. That ROE reflects both the earnings power and the capital efficiency of the EDA model. Cadence does not own fabs, carry inventory, or maintain capital-intensive physical infrastructure. Its primary assets are software, intellectual property, and human talent, the most durable inputs in technology.
Free cash flow is where the story gets complicated. Cadence generated $1.48 billion in free cash flow over the trailing 12 months, still strong in absolute terms, but representing a 20.8% FCF margin. A year ago, that margin was 35.6%. The driver is R&D investment growing 15.7% against 18.7% revenue growth.
That compression is intentional, and management has said so explicitly. Every dollar of R&D flowing into ChipStack and AgentStack is investment in the next revenue cycle, not a sign of deteriorating unit economics. The key question: does the AI product investment generate premium monetization, and on what timeline? If margins recover toward 30 to 35% in H2 2026 as AI tools ramp, the compression is transitory and the story has a catalyst.
On capital returns, Cadence pays no dividend. It never has. Capital is returned entirely through share repurchases. Over the trailing 12 months, Cadence bought back approximately $925 million in stock, returning nearly $1 billion per year on a consistent basis. The buyback pace reflects management's conviction that cash generation is durable and that repurchasing at current levels is value accretive.
The capital allocation framework, invest heavily in R&D to maintain the platform lead, acquire selectively when adjacencies create strategic leverage, return the rest via buybacks. No dividend creates a cleaner signal. When Cadence buys back stock, it is making an explicit judgment that no internal project or acquisition offers better return. That discipline, maintained across multiple management cycles, is part of how this business compounds.
Let us talk about competition. The EDA market looks like a two-player oligopoly, but the dynamics are more nuanced. Cadence and Synopsys control the high-value chip design segment together. Each company is making a different strategic bet on what EDA looks like in 5 years, and those bets are not symmetrical.
In the mission-critical EDA design space, Cadence's rivals fall into distinct categories. Synopsys is the primary rival, comparable market capitalization before the Ansys acquisition, and overlapping tool portfolios in digital design, verification, and silicon IP. But Synopsys made a $35 billion bet by acquiring Ansys, the multi-physics simulation company, transforming itself from a pure EDA peer into a silicon-to-systems platform. It is a different competitive entity now.
The Synopsys-Ansys acquisition creates both a threat and an opportunity. The threat: if SIPS successfully cross-sells Ansys simulation to existing EDA customers, Cadence faces a rival with a more complete hardware-software simulation stack. The opportunity: integrating a $35 billion acquisition is operationally demanding. During that 2 to 3 year integration window, Cadence can deepen existing customer relationships and accelerate AI adoption before Synopsys has a fully coherent go-to-market.
Beyond Synopsys, secondary competitors include Siemens EDA, the former Mentor Graphics, now embedded in the industrial automation giant, and Keysight Technologies, which serves adjacent electronic test and measurement markets. Neither poses a credible threat to Cadence's core EDA franchise. Siemens lacks silicon depth. Keysight's instruments and Cadence's software tools serve different stages of the design and manufacturing flow.
The structural moat: workflow lock-in. When a chip design team spends 18 months building a verification methodology around Cadence's Jasper formal tools, it does not switch vendors mid-project. When a foundry certifies a Cadence sign-off flow at TSMC N2 node, an equivalent competitor certification takes years. The certification moat and the workflow moat compound together, creating switching costs measured not in dollars, but in design risk.
Analyst sentiment is unambiguously constructive. 22 buy ratings, 4 hold ratings, 0 sell ratings. The average price target is $369.08, representing approximately 10.8% upside from current levels. The high target is $405. The low is $275. That range reflects the uncertainty embedded in owning a name at 35 times forward earnings.
Post-earnings actions were uniformly supportive. Barclays and KeyBank both reiterated overweight ratings, citing the record backlog, and raised guidance as validation of the AI chip investment thesis. Goldman Sachs and UBS maintained buy ratings with constructive notes on the non-GAAP beat and the forward visibility implied by $4 billion in near-term backlog conversion. No firm downgraded Cadence following the Q1 print.
The hold camp is led by Stifel, which focuses on valuation. At 35 times forward earnings and 15 times forward revenue, a hold means the business is excellent, management is competent, the numbers are beating, but the risk-reward at this price does not justify adding new capital. That is a reasonable valuation-based position, not a bearish fundamental read.
The 10.8% upside to consensus target is modest for a 35 times forward earnings stock. Normally a software company with 18% revenue growth, record backlog, and a double beat commands a wider analyst target premium. The compressed spread tells you the street believes the current price is fair, not cheap, not expensive, assuming the backlog converts on schedule. The options market had a nuanced read heading into earnings. The put-call ratio was 0.61, modestly bullish, consistent with the pre-earnings momentum run. Implied volatility percentile was 58, above the one-year midpoint, reflecting uncertainty about whether the beat would be large enough to justify the premium multiple. The implied move was approximately 5.8%.
The actual post-earnings move of positive 2.8% was approximately half the implied move of 5.8%. Option sellers collected the full volatility premium. The actual move did not trigger protective legs. For Cadence holders, the vol crush is informative. The market absorbed a clean double beat with measured indifference. That is what happens when a beat meets an already extended multiple.
On the insider front, 0 open market purchases in the past 12 months. 8 transactions logged are all 10b5-1 plan sales. Pre-scheduled, rule-based dispositions by CEO Anirudh Devgan and several senior vice presidents. Devgan's February 2026 plan sale of 15,000 shares at approximately $321.50 generated roughly $4.8 million in proceeds. These are portfolio diversification moves, not directional signals.
The absence of open market buying is notable but not alarming. At 35 times forward earnings, even high-conviction executives manage personal concentration risk through scheduled plan sales. The more interesting data point is what insiders are not doing. No officer has established a new 10b5-1 plan following the post-earnings move, and no plan sales are accelerating beyond their original schedule. Insider red, neutral.
The bull case rests on 3 pillars. First, backlog visibility. $4 billion converting in the next 12 months essentially pre-funds the FY 2026 revenue guidance, reducing execution risk meaningfully. Second, AI leverage. Every additional dollar of chip design complexity flows through Cadence tools, and AI chip complexity is compounding faster than any prior semiconductor cycle.
The third bull pillar is the FCF recovery thesis. Management guided to 45% non-GAAP operating margins for the full year, implying meaningful H2 expansion from Q1's levels. If that recovery materializes as AI products begin monetizing, the narrative shifts from margin compression to FCF inflection in progress, and that shift can add 15 to 20% to the market cap.
The bear case is equally clear. At 35 times forward non-GAAP earnings and 15 times forward revenue, any negative catalyst compresses the multiple rapidly. A backlog slip, a guidance cut, a macro chip cycle slowdown, or a successful Synopsys cross-sell into core accounts, any of these triggers a reset. The stock's 31% round trip from 52-week high to low proved the downside velocity at this multiple.
Our call, buy with patience. The double beat validates the fundamental thesis. The record backlog provides forward visibility. At $333, the stock is roughly 12% below its 52-week high, not at a deep discount, but below peak euphoria. The key condition is FCF margin recovery. If H2 2026 shows margins expanding from 20.8% toward 30%, the stock re-rates on fundamentals, not sentiment.
Cadence is the infrastructure of the AI chip revolution. Not the chips, not the fabs, not the cloud, the software that makes it possible to design all of those things. That position does not erode easily, and it compounds with every increase in chip complexity. The question is simply price. You are paying a premium to own a business that deserves a premium. Whether you are paid for that risk depends on the backlog conversion and the margin story in H2.
Cadence CEO Anirudh Devgan said on the Q1 2026 earnings call, "We are at an inflection point where AI is transforming the way chips are designed, and Cadence is uniquely positioned to lead that transformation." If you found today's analysis valuable, subscribe to Charged Alpha wherever you listen to podcasts. This was Cadence Design Systems, ticker CDNS Q1 2026. I am Hudson, she is Lana. We will see you on the next one.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.